So to calculate the landing fees, first you need to calculate how much weight is actually landing in a given year and then multiply it by the landing fees per ton. Now, the way you can calculate the weight is take every aircraft movement, multiply it by the weight of that particular aircraft, and then multiply that whole result by the landing fees per ton. So this is how it would look like. We would take the 737 movements and multiply it by the weight of the 737. In this, we would add the 320 A320 movements and from it multiply the A320 weight, and then you get the idea. You get the idea. And actually, sometimes to make this thing go faster, holding the control and key and then making it up and down will just make this thing go faster. This is going to give you, this result is going to give you the weight, and if you multiply it by the rate in landing fees per ton and divided that by 1000, because this whole income statement is in thousands, you're going to get the result. Now here I want to talk to you a bit about thinking a bit more about formulas, Excel formulas, and figuring out ways through which you can write more elegant formulas. The formula that you see is far from elegant. Now at this stage, your knowledge of basic math will really help, because in this in this insert function, if you were to ever click this insert function button, you're going to see and select a category of formulas. And if you go to, let's say, well, not financial, but you just go to all, you're going to see lots and lots of formulas, lots and lots of functions that exist in Excel. And the one function that can really simplify this formula is the sum product function. And because that's what we're doing, we're multiplying two matrices, and then we're adding it up, and that's what's called sum product. So to use sum product, I'd like you to do equals to sum product, open square bracket, select one array, press F4 because you don't want this array to move, multiply, comma, select the other array, which is all of these aircraft traffic movements, close the bracket, and then multiply it by landing fees per ton, divide that by 1000. That's a much cleaner formula. And now if you were to copy this to the right, a pretty neat, elegant formula is something that you've managed to create. Let's now repeat this exercise with aircraft, with handling fees. Now, the good thing about handling fees is handling fees are agnostic to the aircraft weight. That's just how this particular airport has done pricing. So we'll literally just take all the traffic movements and multiply it by handling charges per aircraft traffic movement. So that's simply equals to sum all the aircraft traffic movements multiplied by the handling charge per aircraft traffic movement divided by 1000. And Alt HAC allows me to center this formula, and then selecting that cell and Control R allows me to populate all of the other cells. And then similarly for embarkation fees, I'm going to sum up all the passengers and multiply that by embarkation fee per passenger divided by 1000. And again, Alt HAC allows me to center. The other way I can fix this formatting is copy the formatting from, let's say, cell I-54, because I like that format. go to the cell where I want the formatting copied, hit Alt ES and T, and that copies the cell format. And select cell I-55, copy to the right by doing Control R. And next, to sum up, one shortcut for sum up is the Alt and equals to sign. This is going to sum up all the rows that are above a particular item. It's important for whenever you're using this, it's important that there's at least one blank cell between like for example, if this cell wasn't blank, and I try to do Alt equals to sign, it'll also take in the year 2000. So you just want to be careful with that whenever you're using the Alt equals to sign to sum up all these numbers above a certain line item. And now we've forecasted the entire operating revenue, and for the non-operating revenue, we're taking this very crude assumption. This is largely being done because I want to give you more training on the cell anchoring stuff. That I think is one of the most important basic skills that you need to become fast at financial modeling. Is where do you put the dollar sign? Okay, so what I want you to do for row 59 through 61 is you will take total operating revenue for a given year and you will multiply it by this assumption, which is basically saying what percentage of operating revenue is each non-operating revenue item. So for example, cell L15 is saying that 24% of operating revenue is generally going to be airport development fund, which is some phantom line item for which we don't really need to get into what it is. Now, so to calculate airport development fund, you will take the total operating revenue multiplied by the airport development fund as a percentage of operating revenue. Now, here is your final test for the cell anchoring exercise. You've got these two numbers. What you want to do is when you copy right, you want to make sure that this cell I-59 moves right, but when you copy down, you want to make sure that cell I-56 does not move down, but cell L15 does move down. So where do you put the dollar signs? There are two dollar signs that you will be putting in, and you need to think before you decide where to put them. So your dollar signs are going to go to, we want the column, we want to make sure that when we copy right, cell I-56 still moves, but when we copy right, cell L15 doesn't move. However, when we copy down, cell L15 moves. And so in this case, for one of the line items, the row is being anchored. For the other line item, the column is being anchored. And when you do this correctly, you're going to see that there's this other lovely shortcut that you will have to just memorize and get used to. It's called Alt-TUT. Alt-TUT and Alt-TUA. Alt-TUT allows you to trace precedents, and this is just showing you that the calculation that you've done is indeed correct. And so I hope you can see that, you know, this is how we are we're literally just going down this income statement, and we've gotten to a point where we have populated all of the revenue, and we are slowly moving down to EBITDA. So as a next step, let's do operating costs. And the way we've set up this model, we can forecast all of the operating costs based on historical averages, except maintenance, which requires the depreciation and capital expenditure schedule. So we are going to just forecast the salaries, which is based on a percentage of operating revenue. So we're going to say that 20%, 21% of operating revenue is going on salaries, and we want this done with a negative sign because we want to show our costs as negative items. We copy this to the right, and marketing and advertising, we are basing it on total revenues, and similarly again and then all these other operating costs, we're saying, okay, this is a function of all of these other operating costs. So we need this capex and D&A schedule before we can fill out these two line items. And so the purpose of sharing this is that sometimes you can't get to EBITDA without creating a depreciation schedule, because sometimes maintenance is tied to the capital expenditures you're going to do. So at this point, I'm going to save the file again, and I'm going to make another version, which I'm going to call step 2, so that if you have gotten lost anywhere, you can download this step 2 and just begin from there. So let's now get into the capex and D&A schedule. Now, capital depreciation, let's start with what depreciation is. Depreciation is an accounting construct. It's this idea that when you buy a house, every year it's going through some wear and tear, and as you know, the income statement tries to capture the whole truth of what really happened in a given year, cash or non-cash. Now, every year, the wear and tear that is happening on your house, that is getting captured in a depreciation line item. But in many cases, this wear and tear is going to be a non-cash expense, because, I mean, think about it like this. You bought a house, you haven't done any maintenance on it for 5 years. Now, it's not that there is no maintenance need. Every year that you don't do maintenance, your spend will go up. But because you are not spending actual cash on it, it is a non-cash item. That is depreciation. And there are the accounting bodies have a bunch of different ways to forecast depreciation. There is the straight line method, there's the double declining balance method. I mean, if you are curious, just Google what are the different ways to depreciate an asset, and it's really just rules driven. We are doing simple straight line depreciation in our capex and D&A schedule, and in it we're going to be doing a few other things. I want to show you a few other techniques really that will help you that will help you acquire a few more skills, because my view is people learn best by examples, and that's what we will do next. So let's try to populate this capex and D&A schedule. So where we want to start is these lines 11 and 12. We currently cannot line 11 is simply going to be, before we even begin, line 11 is showing the gross book value, and all the depreciation that is accumulated is on row 13. A lot of times on financial statements you see the net book value, which is the gross book value minus the accumulated depreciation. I've split them out because it's much easier to forecast depreciation when you keep the gross book value and the net book value separated. Let's now